risk framing is quite important for me. In terms of pattern matching, it does matter, but it doesn't determine everything.
Yeah.
And so some of the things I would look for are, first of all, we at Catalyst, we talk a lot about the founder market fit, which is what I was referring to
Yeah.
earlier, which is, like everybody's going to have to learn as they're operating.
Yeah.
But if, again, you're not familiar enough with the market, or you don't have to be from the market,
Yeah.
but if you're not familiar enough with the market that you're operating in, your primary market especially,
Yeah.
it means your learning curve is long. It's not even about how smart you are. You're just easier to compete against because you're spending time and money learning things that presumably some of your competition already knows not to do.
Welcome to the Blue Card podcast. This is the second episode for the investment series. Toby, how are you doing?
That question is a heavy one for a founder.
Okay, I should
But I'm
stop asking that
surviving.
question. I think it's your shrink that should be asking that question.
Exactly.
Okay.
Exactly.
Okay, let me just hope you're good.
I'm blessed.
All right. All right. So today we're going to be looking at the intersection of venture capital, climate tech, and impact in Africa. And we have an important guest today. Our guest today is Olúwatóyìn Emmanuel Olubake. He's currently the Chief Investment Officer at Catalyst Fund. And they focus on climate tech, early stage climate tech, climate resilience solutions across Africa. And they are one of our very important investors at Power Labs. So I think I'll pass the mic to Toyin to, take it from there to introduce himself to our audiences.
First, I'd like to say thanks a lot, guys, for having me. It's an interesting series of conversations you guys are having with this, and so I'm glad to be one of the invited guests. But to talk a little bit more about my background. So yes, I'm the Chief Investment Officer at Catalyst Fund. Catalyst is an early stage investor in startups focusing on climate resilience and adaptation across Africa. We currently have about 27 investments across 9 countries on the continent, spreading across various parts of the food and agri value chains, energy, waste and circularity, health, financial and data services as well. Before Catalyst, I worked with a growth investor called Novastar Ventures, who also is deploying a climate fund now. And before Novastar, I worked with Acumen West Africa. I was leading the investment function for West Africa. Prior to that, for the first 10 years of my career, I was mostly doing investment banking, but also did some private equity out of Nigeria as well.
That's heavy stuff.
No.
that's a very rich background,
Yep,
right? And
exactly.
I'm just kind of curious, like Chief Investment Officer, what does that really entail?
Headache.
Okay. Okay.
I mean, so day to day, what do my job look like now? A lot of it, I joined Catalyst after we had a strategy that had been set,
Okay.
investments had already been made, and so right now a lot of it is on the deal sourcing side, guiding investments through our process, refining our process. But also our strategy is to invest in 40 companies initially, and then to follow on in half of those and follow on
Yeah.
again in half of those.
Yeah.
And so there are quite a few investment decisions along the way
Yeah.
beyond just the first one. And I'm quite involved in that process of deciding when and who we will reinvest in out
Yeah.
of the initial 40 and then
Yeah.
out of the following 20. We're still fundraising as well. So there's a whole lot in terms of the day to day, but overarching, it is alongside the investment process, guiding companies through the investment process, finding the companies we want to invest in. We also spend a lot of time supporting the companies we've already invested in as well. We have a team of venture builders who are, ex-operators themselves that are dedicated to support the companies we've invested in within the first year of our first investment usually.
Yeah.
And then alongside that, the investment team also provides support to the companies. And so that's where a lot of my time goes.
Oh, I mean, super interesting, especially on the point around the follow-ons, right? How those decisions that you have to make, right? Which I think people underestimate, like how difficult those decisions are, frankly, right?
Yeah.
You know, you give someone seed capital, right? And we all know the grind of, starting a company, founding a company.
Yeah.
But at the same time, this is it's not for free, right? And you do have to make some tough decisions. So I have to acknowledge that. But I think what's also interesting is what David mentioned, right? About how, honestly, how complex and impressive your background is. I think it's interesting. First, it seems like there was an intense focus on climate, right, across the same part of your career. But also your PE background I also find extremely interesting. And that brings me to my question around, going from PE, right, to VC is interesting. I won't say is crazily uncommon. However, you're going from a very capex intensive way of investing to an industry that, maybe until recently, it was like software. If you're hardware, you don't even look at that. So I want to know what led to your decision to make that transition. That's one. And then the second part of that question from me is around, how did you see any synergies or any way that your experience in private equity helped you to be a better investor, not only across VC, but even in companies that are deep tech like ours?
It's a good question. So I think that there are a few different things. I remember when I first started my job in PE, my boss at the time who hired me, he talked about, he also had a background in investment banking, and he had been CFO at a couple of companies as well. And he told me that, the thing that some people are not able to do is switch mindset, that it's not so much about skills. It's not just about skills. And analytical skills matter, of course, but it's about being able to switch mindset and broaden your skill sets. Because in investment banking, you're building models, doing financial analysis, deals, and so on. Private equity, you're a co-owner. And so you're no longer just a transaction person. You're now thinking about how to grow a business, how to ensure a business has good governance, especially because you are an outside party, even though you're a co-owner. You need a commercial mindset. Investment banking, I'm just selling whatever I have to sell. As an investor, I need to pick the best investment. And so I need to be able to understand, what do I think will make this a good investment? And so that's a mindset thing. And I think it was probably harder to switch to that mindset from investment banking than to switch from private equity to impact investing or growth equity or early stage, because of that switching between transaction versus owner mindset.
Okay.
So that's one thing. But you're right. I mean, there are a few different layers of the differences between private equity and other parts of investing, especially early stage. In some ways, my mindset was already different. And so, to the question about why I was motivated to make the move, I've always wanted to use finance as a primary but not exclusive tool to support entrepreneurs. And what I found is that, generally speaking, the more advanced the company, the more structured it should be, and it typically is. And then the ability to influence and shape decisions is typically more limited, ultimately. Possible, but more limited. And so for me, at the earlier stages, the ability to really have that strong relationship, it's not about the strength of the relationship, but the ability to influence and shape. And typically, it's not necessarily just about what people know or don't know, but as you will know, a startup environment is always a resource-strained environment. And so being able to help people shorten the learning curve, access critical resources, that's a lot of, how I think I want to be able to add value. And so that was that's been a lot of the motivation in coming to the earlier stage of investment. And then from a capex perspective, definitely, you know, private equity typically, especially on the continent, typically invests mainly in real economy businesses, distribution, warehouse, processing, whatnot. Even when it's technology, it's like, you know, enterprise technology or something like that, where it's a completely different thing from coming into a company that's still figuring out the MVP. You know, not even yet at product market fit necessarily. And I think the way you assess risk has to change, because the way you assess risk for private equity, again, is looking at a business that's either profitable or near profitability. You come in and, you know, you understand how within maybe a year or two at most, you make certain changes, you help the business certain ways, and it's profitable. Venture, you don't even know if there'll be a business in 2 years. So, you know, the way you assess risk changes. At private equity, a lot of your assessment, you're assessing the owners, the management, but a lot of your assessment is also on the business. It has an operating history, so you're looking at that history to learn a lot about, you know, the business and the opportunity and the risks. Again, in venture, it doesn't have that history, and so you're assessing, on one hand, the founders, the leaders of the business, the operators within the business, but you're also assessing the markets. What are the risks? What are the opportunities of headwinds and tailwinds? You need to come with an understanding of the commercial landscape. Like, again, does this even make sense or not? And so the way you kind of frame risk and assess risk is one of the things that changes quite a bit. And that's also something I've had to evolve in all these different roles as well, in terms of how I've thought about risk.
That's interesting. Really. Like the part you mentioned about, like, you know, coming from where, you know, you focus more on models, but when it comes to like venture, you care a lot about like the founders, right? You care a lot about the market, like your own thoughts about the market, how is it going to grow over time. But one thing I know, like in all these your different arts, you're probably very used to saying no to a lot of things. So my question is, you know, have you ever said no to an investment that made financial sense but doesn't feel like aligned with your own should I say your ethos or thesis, or you know, like everything makes sense in terms of financially, but it's not clicking.
So, I mean, yes. There are a few different ways it happens. The most common is that you come across an opportunity that looks financially interesting or compelling, but it doesn't fit with the strategy you've raised money to invest in.
Okay.
And it's simple, but it's important, because I'm not investing my own capital.
Yep.
We've raised money from third parties on the basis that we're going to invest in a certain way. And they've usually given us that money not just because they want returns, but a lot of times, especially for Africa, where fortunately and unfortunately, most of the external capital is development oriented. So it's very focused on non-financial goals. And sometimes it's very specific what those investors want. And so no matter how much, like if you offer me an opportunity, so like I said, we're climate focused. If you offer me an opportunity that I'm guaranteed going to 1000x my money in 5 years in oil and gas, I can't do it. Because, you know, that's not what I collected funding to invest in. So that's the most common way. It's pretty simple, and that strategy, it could also be staged. We like to come in pre-seed, seed, and then follow on later on. So if you bring a series B or D opportunity, I can't do it. So the thesis fit is the most common reason to say no. There are other times where they're more strategic things, like maybe you're raising 10 million and for whatever reason, you're happy to take my little investment, but I look at it and my stake in your business is not going to be big enough. Like I said, you know, both as an individual, but also as a firm, we want to come on board as partners. If we don't have the leverage to come on board as partners, then it doesn't fit with the way we work. And so those are other reasons why we would say no. but I know I also kind of get to where you're going to, and you know, I've seen opportunities that on paper made a lot of sense,
Yeah.
right? And I've said no because I couldn't see myself working with the entrepreneurs.
That's
Sure.
I
I
know,
was
I know that's where you're going to. So
that way
I'm
everything makes sense,
That's
I'm getting
but
the
yeah.
small things out of the way
I don't think I
first.
can have like it because it's a marriage, investors and
It's very important.
entrepreneurs. So
Yeah.
you need to make sure that
Yeah.
people you can go.
Absolutely.
Yeah.
Like, there's no guarantee of the future, but at the same time, you can't start a relationship expecting it to crash. And so the dynamics of how we engage, the trust we're able to build
Yeah.
in a very high pressure, short, intense, unbalanced
Yeah.
period of time, it still matters hugely.
Yeah.
And it's not to say that these judgment calls are always right. We could
No.
also be wrong.
No.
But at the end of the day, we've also been, our investors have backed our ability to make decisions, right? And so we have to develop our convictions and stick with them.
Yeah.
Like I say, intuition is based on data. When people think, oh, intuition it's trained model.
Exactly.
Yeah, so
Not all data is ones and zeros.
exactly. Yeah.
Yeah.
Yeah, and I think that's a very interesting transition for me because when I think you mentioned around founders, right? And I think a lot of things get down to yes, obviously market dynamics. You run you have your thesis, all that stuff, but you keep coming down to founders and the operators within that company. There's a buzzword that I tend to hear in a lot of VC podcasts around pattern matching. Right, and they always say, in all these VC courses and everything, you talk about like you need to kind of create a strong pattern matching system, and then you kind of use that template to when you speak to founders, if they don't match this pattern, maybe they're not a good investment. I guess I have a 2-point question here. Do you believe in pattern matching as a way, right? Like, do you believe that there's a certain pattern that if every founder you must invest in has to have, right, or match with? And if you do, can you give us some insight into what those patterns are?
It's a complex question. Let me start by answering it this way. Do I believe in pattern matching? Yes, but to a degree. So if you think about, I like your point about data. If you think about 100% of how I come to a decision, is pattern matching part of that? Yes. Is pattern matching 70%? No. Is it 60%? Probably not. Maybe for me, I would say 30, 40%.
Yeah.
So there are a couple of things. I believe that, as an investor, I feel like there are a lot of investors who frame their decisions as certainties. And I understand it because, again, you're managing somebody else's money. You want to have conviction. And so, you think about where you see risks and, you try and eliminate them all.
Yeah.
The way my mind works, the reality is we won't eliminate all risks. And so what I choose is, what are the risks that I'm comfortable holding? There's some risks I can eliminate. There's some risks that I can only mitigate. I can't eliminate them. And there's some risks I must just accept.
Yeah.
So to give a simple example, I had a conversation with somebody early last year. He was not based in Nigeria. He was thinking about investing in Nigeria, and he was asking me about FX. I think it was the year 2024. Can you see? Everybody is taking a deep breath. And, I spoke grammar. I first spoke all the grammar. New administration, different positioning, clearer strategy. And we're seeing all those things play out, right?
Yeah.
But at the end of all the grammar, I told him that, look, at the end of the day, if you want to invest in Nigeria, you must accept currency risk. Full stop. If you are not willing to accept currency risk, I don't think you should invest in Nigeria because your blood pressure will be like a roller coaster.
Yes.
Do you understand? Yeah. So those are risks that you can do a little bit to mitigate it. But if you can't accept it,
So your model must accommodate that risk. Yeah.
do you understand? Whereas I don't know what's I can't think now of a specific thing. Maybe along the way I will. But there's some risks that I might not want to accept.
Mhm.
Do you understand?
Yeah.
And so, like, okay, maybe I'm investing in a team of founders, very early business, MVP. They are not in the market they're operating in. They are not from the market they're operating in. They have so much to learn, but they are not close enough to learn it quickly enough. That's a risk that I could choose not to accept
Yeah.
because it's like, you know,
Yeah.
what's the point here?
Yeah.
And so pattern matching, so you know, risk framing is quite important
Yeah.
for me. In terms of pattern matching, it does matter, but it doesn't determine everything.
Yeah.
And so some of the things I would look for are, you know, first of all, we at Catalyst, we talk a lot about the founder market fit, which is what I was referring to earlier, which is, you know, like everybody's going to have to learn as they're operating.
Yeah.
But if, again, you're not familiar enough with the market, or you don't have to be from the market, but if you're not familiar enough with the market that you're operating in, your primary market especially, it means your learning curve is long. It's not even about how smart you are. You're just easier to compete against because you're spending time and money learning things that presumably some of your competition already knows not to do.
Interesting.
And then we also talk about founder solution fit. And so what exactly is it about these founders that tells me this is a solution they should be building? Like, why would you win in this space? Why will you figure out a product? Why will the market believe you? You know, those are things that you could say that they're patterns that we look for. We also have realized that, you know, selling matters in two big ways. You need to be able to sell your vision. Founders need to be able to sell their vision. They need to be able to sell their vision to investors because even if we understand and believe you, the likelihood that the capital we're bringing is all you need is unlikely. So you need to be able to convince other investors as well. You need to be able to convince people to join your team, high quality people to join your team. That's a vision thing because from day one, you're probably not paying them what they can or should be getting somewhere else. So it's the vision they're buying into. And so that ability to sell in that way is important. You need to obviously be able to sell to customers because, you know, there's a difference between a product and a business and its market. Do you understand? It's true.
Yeah,
you know.
there's a funny quote that I think David says, you might have a product.
Okay. It's popular out there where, you know, these quotes, I don't like, so is there a gap in the market, but is there a market in that gap? You know, like because people are like, oh, there's this problem. Maybe there's a reason why nobody has formed a business about it. You now think, oh, Einstein, let me go and do it. Now see, there's really no market there.
And and to that point, like this is where the founder solution fit comes in because the people that understand that market, they know why they're like this thing that's not working. They know why it's not working. Do you understand? Somebody can come today and say, oh, they have some technology that will make it easier to do land rights in Nigeria. Technology is not the problem with land rights in Nigeria. Do you understand? And so, you know, I don't need to invest in you before I understand. I learned that lesson.
How do you should I say, how do you deal with land touts? How do you do?
I didn't say anything.
No, I'm just wondering. I'm just thinking of the.
But yeah, do you understand exactly?
How do you do the human element?
It says an AI app that will talk to them in local language. Okay, let's be going.
I wish them well.
And a lot of times, I say like I'm willing to be wrong as long as I have my convictions in the decision I'm taking. So I could say yes and be wrong, but why did I say yes? I could say no and be wrong, but why did I say no? So those are some of the things that I would say they become patterns that we look for. It's not necessary, and yes, some of these things we've seen them validated in other investments, either ours or others or so on. But those are some of the examples, and they don't form the entirety of the decision, but they are quite important.
Clear.
Before I go to my own question, I think, you know, for me, I think it's really about updating your files because some things that you like some inputs that made you make that decision or made you think that way, maybe it has changed, right?
100%.
So if you don't update, you're still making decision that is actually incorrect.
Absolutely.
someone else is seeing that arbitrage opportunity and quickly, swoop in and, so I have seen that happen a lot.
Yep.
Like some people did not update their priors about, even government,
Mhm.
about some of these things, even like outside like geopolitical risks too,
Yep.
right? And it's changing a lot of things
Yep.
because people didn't. I'm sure to be one of our earlier trips down. So I think we went to meet one of our angel investors back then. I remember the things he said, and those things happened as if he was as if he was Nostradamus.
Yes. Yes.
Regarding currency for
Yes, reading
FX,
the markets.
Yep.
regarding what would happen to the FMCGs,
Mhm.
everything played out the same way. So because he had updated his priors, right?
Yeah.
And
Yeah.
God,
No, I was going to say there's an interesting thing where the wisdom of experience, there's an effort it does not require sometimes. Like when you've seen something play out enough, you know what to expect to a certain degree. You can position in the way that I might be a sharp young guy and maybe I can react well. But you're not even reacting because you know it's coming. So you have moved before it happens,
exactly.
And so, there's a blend. You do have to update your price because situations change. Like right now, AI is upending everything. So,
I don't want to get there because
Uh,
it has a whole different world. Power Labs operates in like a frontier market where energy reliability is inconsistent, right? Even as we stated, we've had the grid switch to another more reliable source, right? So the thing is, many consumers are their own utilities. Like in Nigeria, you provide your own power. If you are really serious about your business, you have to provide your own power. So many investors will kind of shy away from that kind of high complexity markets. Like the too many balls to juggle, right? Regulation, like all of these things. So my question is, what's convinced you beyond the team, beyond the technology, that Power Labs like taking a stab at the problem as a chance in succeeding in such a challenging environment?
It's a good question. I mean, for me personally, my father was a power engineer. I've worked briefly, but I've worked in an industrial turbo machinery setup. So I'm not an expert in the industry, but I'm not a layman in the
familiar with.
industry as well. And beyond that, I think to some degree, to a slight degree, I think 60 to 70% of Nigerians are, like you said, power industries on their own. And so there's an element of a familiarity with the problem and the context to the problem that is quite interesting. And this is one of those opportunities where a lot of people also don't realize the unfortunate but real place for Nigeria in this landscape of, challenges with power. I don't have the most up-to-date data, but I know that as of around 2020, there were about, I think it was, depending on who you speak to, between 600 and 850 million people that did not have access to adequate power supply, adequate reliable power supply. And Nigeria was the single biggest contributor to that in the world. I don't know where the numbers are today, but I'm pretty certain that Nigeria is still the single biggest contributor. So, that's a huge opportunity. Problem on one side, opportunity on the other side. And then for the specific solutions that Power Labs are providing, there's a clear understanding of how your potential customers, you're not going to tell somebody you may have headache, buy Panadol. Do you understand? It is this headache you have.
Yes.
I'm selling Panadol. Do you understand? And so it's kind of that element where, there's a market. Is there a gap in the market? There's a gap in the market. There's a market in the gap. And do you understand? All of them. And so it's kind of understanding that, and obviously having a lot of confidence in the ability of you guys to really tap into that, liking the way you guys thought about the product, and the traction that you guys had even at an early stage.
All right.
Okay. Amazing. And I think a final one from me. So you obviously have experience, in VC, but in not only in Catalyst, right? You mentioned your prior experience, um, and obviously you mentioned the number of investments that Catalyst Fund have made. I'm curious if you're speaking to an investor coming into the market today. David spoke about updating priors, right? What would you say? I mean, you mentioned AI, which is, that aside, what would you say is the single biggest prior in this specific market that we're operating in, energy technology markets, right? You want to put it that way. What would you say is the biggest single prior that an investor should be updating, or what would you say is a difference in the market today that wasn't there before? Because I don't get it transparently, right? We know we're in a market where a lot of people have been in this market for over a decade, right? And the certain like expectations that were had early on, right? I remember David and I were talking about some companies. There was actually recent interviews out there, right, where a founder of a very popular solar enabled company, I don't want to mention the name, but it's out there. He mentioned how like it's only now that's like they were too early. They were a couple of years too early, So I'm just curious to know, right? It's almost like you took a big risk, right? in a lot of ways, saying I'm still betting on this thing that's might still be another 10 years late, right? So yeah, how do you think about what was the biggest prior you had to update, right? Or you advise an investor in this space to update, right? When you're thinking of investing in a company like ours.
So I would say that on the macro level, deregulation is a huge thing. It's just a really big game changer.
Yes.
We've talked about everybody being a utility, both in a real sense and as a joke, but there have been a lot of policy restrictions as to how you could do that and what exactly you could do. The regulation has already been passed. We've already seen states like Lagos are, they intend to make the fullest of it as soon as possible. And so what it just means is that people who have already been doing a lot, but not all that they could to manage their supply and cost of electricity can do a lot more legally. And states like Lagos are moving quickly to enable that. And so I think it's taking shackles off in a lot of ways. So that's probably one of the single biggest things I would say from a macro perspective.
I would agree with that too.
But it's not the only one. No. The other thing is, I don't even know what to call it, but this whole thing with commodities, where not so much commodities as much as the Dangote, the refinery.
Yes.
Because it changes the market. It has changed the market quite significantly. It doesn't start with Dangote, because we saw 3 years ago how diesel went from an average of like 230 to where is it now? Do you understand? And where will it be tomorrow? Do you understand? So it's just climbing the stairs. It's going somewhere. I remember how, like, call it 2020, 2018, you walk into an office building, rooms that are empty, AC is on. Do you understand? Now, Papa, use the fan. Do you understand?
In some places, it's a fireable offense.
Do you understand? It's like, use the fan, open the window. Do you understand? Like, everybody, they didn't teach people. Everybody is a lot more power conscious. I lived in Ghana for a year, and I saw how, because they pay, I've always described this as, when you pay cost plus for your power, the way you use your power changes. In Ghana, they pay cost plus. So all the appliances are rated. When you're buying your appliance, you know that, okay, this AC is cheaper than that AC to acquire. But you know that this one that's cheaper, at least, is not going to finish my electricity anyhow. Costs. Do you understand? So people will opt to buy that. And it's not just wealthy people opting to buy that. It's people because they face the economic realities of their decisions. And that was one of the things that subsidy, kind of shielded us from, the economic realities of our decisions. when it comes to power. And this
That's a
this
very
for,
good
for
point.
for you guys is it's happening positive for you guys in both ways.
Yeah.
Because it's not just the fuel subsidies, it's also the electricity subsidies that's been removed
Yeah.
and the restructuring of the
Yes.
pricing there. And so it's another macro point, but that's another big piece. Because it changes things long term.
Yeah.
You know, I had a debate with somebody last year that talked about how, some subsidies have been removed before, but they weren't really removed. They came back. And I was like, yeah, this is where you have to read the markets. Like when you look at this administration and the positioning they are taking, you could say in theory that, oh, yes, it's possible, but it's not really possible. It's not logical. They've paid a political price
Yes.
to do this.
Yes.
Why would they walk back on it?
Yeah.
And so I think those are some of the big sort of tailwinds that push in the right direction for you guys.
I think I quite agree with that assessment also. Like if we just look at the market for the past couple of years and even seeing this is even playing out in other countries too.
Yeah.
Like, seeing what is happening in Pakistan, some
Yeah.
other, third world countries.
Yeah.
So, okay, thank you very much. I would really like to thank you for, coming here today and, enlightening us about capital for like businesses such as ours. So, before we close, where can listeners find you on social media? Are you on social media? Are you on Twitter?
This is when you have now caught me. Do you know, I don't even know my handles.
Okay,
The
better.
best place to find me is probably on LinkedIn.
Okay,
At least
LinkedIn.
it's just my full name.
So,
there.
okay,
Yeah.
LinkedIn makes sense.
Yeah.
Twitter is a dangerous place.
Ah,
It's a
no,
treacherous
no.
place. Yeah, so that was Olúwatóyìn Emmanuel Olubake on the Bookout podcast. And if this conversation resonated with you, please share with your friends and check on all platforms: Apple Music, Apple Podcasts, Spotify, YouTube. You can find this podcast here. Thank you very much. Don't forget to follow us on Instagram, on X, formerly called Twitter, on LinkedIn. It's Power Labs HQ at Power Labs HQ. Thank you very much. See you next time.
Thank you, Tony.
Podcast.
Thank you.
Thanks for having me, guys.